Hi, everyone. Welcome to this week's weekly real estate Q&A. I'm here with Todd today, and we are going to be reviewing the questions that you had been asking over this past week.
I think we're starting to hear where people are going to walk away from their mortgage, which is kind of new.
It is.
And I think we could talk about that right off the bat. So you want to go ahead and shoot the question?
Yep. We're going to ask the question right now. So we had a viewer say, home values continue to decline in my area, specifically Bradenton, Florida. My home's value has declined 18% since January. Can the government step in and stop home value decline? If not, my husband and I are going to walk away from our mortgage we purchased in 2020.
That's a good question, because as we come into June with the FOMC meeting, the Fed is predicted to at least stall the interest rate hikes. Some may think, or some do think, that he's going to actually drop them a little bit to stimulate the economy. We know we've got a big election year coming up, yes, and the housing market is very interest rate sensitive. But the question here, Melissa, is that it really doesn't go on to say is, are they wanting to walk away because of a decline in home value, or are they wanting to walk away as a result of them not being able to afford their payment? Or I guess we could throw a third scenario in there, that maybe they want to sell. They bought in 2020. Is that what it was? 2020. Mm-hmm. And maybe they wish to sell already. And this is a big problem, because, you know, that would be a reason to walk away if they can't afford it, if the values are dropping. Now we throw the third thing in there, that if they can't sell it, and a lot of people don't realize that you need about 10% equity in your home in order to sell, with commissions, transfer, recordation fees, depending on what state you're in order to come out and break even on what you paid, but not counting maybe what you owe. So a lot of people that only put 3.5% down on, you know, let's say an FHA, or they did a VA at 100% financing, they only paid closing costs. They could be underwater, as so many homeowners are that have bought in the last couple of years. But this brings out an interesting thing, and we have an article pulled up here by Pew Research. And I'm starting to feel a little bit of that we are going to start to realize now home price declines and further market declines than we've seen. And, you know, a lot of people say, well, we're not going to experience a housing crash or any more of a decline than what we've already seen in some markets. And in some markets, they haven't seen it at all. But what I want you to understand as we look briefly at this article is two things. Number one, it takes about 6 months when interest rates rise before we actually start to see the effects in the housing market. So it's not a very instant thing, right? So when we started seeing interest rates, when the Fed started raising rates at 1/4 point in March, and then in April they raised it 1/2 point. We still were seeing price inclines, home prices going up, because a lot of people, it takes time for this to kind of sink in and start to see the net result of such an interest rate sensitive sector like housing. But let's take a look at this article, because Pew Research, and guys, this is back in 2010. So we had the great recession that is well underway at this point. We started seeing the housing peak was like in 2006, leading up to the big crash of '08. We call it the crash of '08. But it took years before we saw the effects of it. But I want to kind of just go over this article for a second, because it's titled Walking Away, and we'll link the article down below. But it said in this, they did a poll, and basically it said that a majority of Americans back then had said that it's simply not okay for people to just ditch their keys to their home and move out. And, a lot of what we're seeing here, just like this question, they're saying we're going to walk away. We're starting to hear that now. I've personally seen, a listing that we were interested in, my clients, where the seller moved out of the house, just ditched it. They tried to sell it on the market recently for 4 months. They couldn't get out from what they owed, so that's why the price was higher than what somebody was willing to pay, and they just basically walked away too. So we're starting to hear this. We're starting to hear more short sale scenarios coming on the market where they're selling where it could be short of what they owe on their mortgage payment. But here it said more than a third, 36%, say that the practice of walking away from a home mortgage is acceptable. Now, this was back in 2010 in a poll, a survey that they took of almost 3,000 adults conducted from May 11th to the 31st, again, 2010. But let's take a look here. So basically, what they were saying is the reasons why it was okay to walk away was because, number one, they were unable to live, comfortably. So 14% here said that they could live comfortably. 19% said that they meet expenses with a little left over. 25% said that they just meet basic expenses, and 22% that they said that they don't have enough money to afford everything at all. And it goes on to say that back then, nearly 48% of all homeowners say that the value of their home declined during the recession. And actually, it was this group of people that mostly said that it is okay to renege on their mortgage. So I guess, this the question here is, what is going to happen over the next couple of months? As we see, interest rates are still, they can't just drop interest rates. And another important thing here is that I think it's clear that the Fed has to reset to prepare for anything else that could happen. And they're going to do that through quantitative tightening. And, basically they're going to start reducing some of the mortgage-backed securities, or they have been reducing it, so they're not investing in mortgage-backed securities, these long-term, liabilities essentially that are paying little to no money. And so they're paying more in expenses than they are in the income that they're bringing in these mortgage-backed securities. So they're going to be dumping these. They're going to be pushing mortgage-backed securities to the investor market and money managers. And these managers, these funds, they're going to want to see profit for their investors. So I think interest rates, though we may see a decline temporarily, I think they're going to go right back up again, and 7 to 8% may be the new norm.
It's also to be noted that during this time of the Great Recession, over 6 million households lost their homes to foreclosure.
And as far as part of the question, can the government do anything to step in to prevent home values from going down? They're doing everything they can to prevent foreclosures, right? They don't want another 6 million people to lose their home to foreclosure, despite a lot of people just made bad decisions, buying decisions, but they are still bailing people out, right? From COVID, so right. Now we have the 40-year mortgage that FHA just stepped up to, to match the VA, ability to recast any defaulting loan balances into a 40-year term. But also as of January, and we spoke about this before, the Biden administration has increased from 25% to now 30% of your defaulting mortgage balance can actually be taken off of your loan completely and wrapped into a second type of loan that would go on the back end when all of your other payments have been paid 30 years later or 40 years later. This up to 30% loan balance is interest free. You don't owe anything on it. You don't have to pay payments on it. That's a big deal, right? Almost a 30-year mortgage. Going to dump it on the back end. And then if you sell your house, you have to pay it off. Or if you finally get to the 30-year or 40-year payment, then that money is due and owing, that additional 30% that they recast for you in a different loan. So the government is stepping up. They're doing everything that they can, I guess, on whose backs, I don't know, I guess ultimately taxpayers, but they are trying to prevent this. But this is really back in this time of 2010, around that time is when the government stepped in and started buying mortgage-backed securities. And they bundled all these loans together and sold them to Wall Street. So, a lot of things happened back in that day, and we'll see what new things to come.
There are so many questions, though, that you guys are asking pertaining to these loan modifications. We had a viewer say, I wonder if those borrowers who take advantage of that 30% loan reduction are restricted from taking out an equity loan. Am I wrong in thinking this modification would give them 30% instant equity?
This is a really good question, right? Because you would think that, yes, it would build another 30% ability to take another 30% out on the house in debt, but it's still attached to the deed. It's still a debt. So no, it's not going to change the equity position as to whether you can get a third loan and ignore the second loan of 30%. No, that's not going to apply. In fact, what they will do is they'll look at the overall amount that's owed on the property and determine if there is any equity at all. And for a lot of people that just bought, in the last couple of years, I don't think home equity lines of credit, unless they put down a massive amount of money, is going to be even an option.
Mm-hmm. We did have another question about the 40-year FHA as well. We had a viewer ask, what does reselling a home that has a 40-year FHA tied to it, people that bought what they couldn't afford and now they are trying to escape, what happens to sellers and how does that affect a buyer?
Well, it could prevent them from selling the house, at least without selling it short. Because especially for these, longer term loans, when you first buy a house, and that's what we've been saying all along, is a lot of people don't realize that when they're buying a house right now, in the last several years, they're stuck in that house for 7 years, 10 years, however long it's going to be before they have enough equity, that 10% equity that they need for them to move, unless they have the money to just write a check to the bank for any difference or any, imbalance. But the issue here is that the longer the note, the longer you're stuck because you're not buying down. We know that you're buying a payment, but the bulk of the payment goes to interest rates, the interest rate, portion of the loan. A very little portion of your payment actually goes to buy down the balance. So if you have a $400,000 loan, in 6 months, you almost still have a $400,000 loan. In 2 years, you almost still have a $400,000 loan. I mean, you've paid very little down on the principal of the loan. So you have to sell that house for at least 10% more in order to satisfy the loan and come out with $10 in your pocket, right? I mean, you just don't have any equity.
Mm-hmm. So in transactions, we're seeing more contingencies now than we have over the past 2.5 years. And we did have a question come from a viewer regarding someone who needs to sell their home, but they are putting an offer in a house. They just want to have a contingency in there that they have to sell their home before they go to closing. So we did have a viewer say, I've always thought that I have to sell my home first, contingencies are stupid. What if your buyer is an and wants way more than their home is worth? I won't be getting into that trap.
It's a great comment, but what people have to realize, so if you're trying to sell your house right now and somebody is moving up, or even if they're moving down, it doesn't really matter. A lot of people don't have the money to buy a house or two houses. So, if they need to get financing, and your house isn't selling, you may need to look at one of these options, right? This contingency of, hey, I want to buy your house, but I need to sell mine first. And the way that works is, and I get what the question is. They're saying, well, what if this person buying it's greedy and they want to make up, any sales difference or whatever from what they're maybe even overpaying from this seller, and they want to make it up on the back end when they sell their house. Well, that could be sticky. So what their agent has to do, what the seller's listing agent, I know this sounds confusing. So we have a seller that has a house for sale, and we have a buyer that wants to buy their house. But in order to do so, they have to sell their house, right? It's a contingency. The seller's agent has to connect with the buyer's agent for their home and schedule a time to talk about it. And if it's in the same state and it's close by, that listing agent, seller's agent, should even preview it and run their own analysis on whether it's worth what they're asking for. So you really have to rely on your listing agent. If you're the seller and you get one of these offers that's contingent upon them selling their home first, your listing agent needs to be involved with their agent to make sure that they have a good feeling that it can actually sell for that price, right? So, it's not unreasonable to ask what kind of a marketing plan they have, what strategy, how long they think it's going to take to go under contract. but it is very risky. This is traditional real estate though, guys. Prior to all this cash movement, and cash buyers and investors just stroking checks, for homes, this was a standard traditional type of contingency that we saw all of the time. So it does work. It does need some finessing, and you have to be, on top of your dates and things like that. And it's a good chance that it may not sell for what they need to get. So you want to know, do they have a mortgage on it? How much is the mortgage? Is it, are they willing to drop the price and get aggressive if it, after the first week or 10 days on the market, they don't have an offer? And then the seller has to determine, do they want to take backups, right? And there is something in our MLS that could be active under contract. You've got, two types of ways to put a house in a pending status. You've got actual pending. That means it's under contract or an accepted contract, and the seller doesn't wish to entertain any more showings. And then you have what is called active under contract, which means that there are contingencies and the seller would like to continue showing the house and, entertain these backup offers. So it is a little trickier when you're getting into that, but it can work out for you as a seller. In a lot of ways, you can maybe even make more money if your house will appraise for more money by getting some, giving them some time and allowing them to do what they need to do.
Okay, let's talk about the real estate agent really quick, because we did have a viewer ask a question that what if a real estate agent was representing two buyers that wanted the same property? So the question came in, as a potential buyer, have you ever had the thought that there might be another potential buyer interested in the same property? There is nothing illegal about a spouse or friend of an agent bidding for the same property, but they might have additional knowledge of your offer or potential offer.
Happens. Yeah, it definitely. You can't do it. So we don't allow it here. It would be a major conflict of interest here. And, and I don't know how it could happen anywhere. I don't know a lot of the different states and their agency laws, but it does happen from time to time where this scenario occurs. You're an agent and you're helping buyers, right? So let's just say you have 4 or 5 buyers that are looking in a specific area for a specific house and a specific price range, right? There are from time to time, situations where you have more than one buyer that would like to put an offer in on that same house. Mm-hmm. You as the buyer's agent have to turn over anyone else wanting to bid on that property or put offers in. You can only represent one, right? Because it's a major conflict of interest. So what you have to do is, get with your broker. The agent would get with their broker and say, look, I have this scenario. What agent would you recommend? Or maybe that agent even picks somebody that they would recommend to handle it. The issue, guys, is this. The agent that is handing you off because they think that you're probably less inclined to be successful at getting it. That's what happens a lot of times, right? Human nature. I'm not saying that that's guaranteed, but think of human nature. Well, I'm going to keep the one that I think is going to actually get it, because this agent knows your financial qualifications, what you're willing to do, what your personality's like, what an inspection is going to be like with you. Maybe they've even written offers before. So in those scenarios, and they do happen, you're getting passed off, chances are, to somebody else, and you're getting passed off because this agent thinks that you're less likely to make the deal happen. That's just my experience with it. And then they'll gladly take you back after, they try and negotiate with the one that they kept, right? And then they lose out too. Sometimes It's not always, that doesn't mean that they're going to win. But then they'll gladly say, oh, come on, Tom and Mary. Oh, I gave you up on that one, but come on back with me. Meanwhile, the other agent's like, yo, I'll keep you.
Right.
That's right. Like, I'll keep you for myself here. But yeah, you have, it happens all the time. You can't really, in my opinion, do it ethically. And, so you guys, that's why we tell you to interview your agents so that you can say, how many buyers are you working, with that are the same as us, looking at the same areas, looking at the same prices, looking at the same type of stuff. it's a valid question to ask an agent. And if they do say, well, I do have several that are in your sending the same listings to, you guys have to judge for yourself whether you want to say, we're going to move on and find somebody that maybe isn't, representing others that could be potential conflicts. But if it's a good agent and they have, they do a lot of business, they probably have a contingency plan in place. So just talk about it.
And I think it's a good idea to ask the agent that you're interviewing, what would you do in this scenario? Say you had us and another buyer that was interested in the same property. What would you do?
All right, guys, well, there you have it. There's our top questions of the week.
Yes. Thank you so much for all of your comments and questions.
Keep them coming. We appreciate you. Share us with your friends that need to hear this kind of stuff. And we certainly love our audience. And thanks so much for watching.
Yes. So grateful and thankful for you. And we will see you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.